Welcome back, everybody. I'm Mark Peter Davis, managing partner of Interplay. I'm on a mission to help entrepreneurs advance society through doing what they do best, building the future. And this podcast is part of that effort. We're getting back in the saddle here. We took about a month off for winter break, and things have not slowed down for us. We are on the go, lots of business building, lots of activities within Interplay. I have a lot of travel scheduled. I'm currently down in Miami for a conference. I'm getting a talk with a group of other business leaders from around the world. Super interesting stuff, learning a lot. But the party has started. And so today we're recording from my hotel room, and we're going to jump right into it, back into our partner meeting. And we look forward to getting the show back going. We'll be producing weekly going forward until you hear otherwise. So ready or not, here we go. All right, Fong, hello from Miami. You know I'm down here. Before you start, there's a bizarre phenomenon taking place down in Miami. I came down from New York's 30-degree weather for a conference. I am here in this wonderful, warm, tropical, 75-plus degree paradise. And I get in the Uber. I get to the hotel. Everywhere I go, it's freezing. I don't get it. The Miami folks blast the AC. It's like 60 degrees everywhere when it's 80 outside. So everyone's wearing sweaters indoors. Who knew? Anyway,
air conditioning is the worst.
Yeah, I don't get it.
You're gonna get a cold.
And like over air conditioning? Yeah. Like take it from 80 down to 70 maybe, but isn't it like an understood human thing that like 70 to 72 is perfect? Isn't that universal?
I'm too cold at 71. 72 is perfect.
See, there you go. So it's understood. It's a universal understanding. Anyway, all right, let's jump into today's lesson. We're glad to be back here. What do you have for us?
So today I'm going to be talking about pricing strategies again. So we've talked about pricing earlier on in the podcast, but it's such a complex and important topic for both startups and later stage businesses that I thought I'd come back to it again today. So last time we went over the basics, 3 different types of pricing, and talked about some general concepts across all sectors. Today, I wanted to specifically talk about pricing in B2B businesses, which in many ways can be different from DTC strategies. A lot of startups make the same mistakes in pricing when they go to market. So just wanted to give you guys a few things to keep in mind. First thing is to engage your customers in determining pricing. So yes, you should do your research, know what competitors are charging, have benchmarks, look at customer data, but don't just sit in front of your computer screen. The most important part is getting to know your customers. Meet with them. Meet with as many of them as you can and ask them questions about their experience and get to the heart of their pain points. Use that information to come up with your pricing strategy. Some questions you can ask them is, when was the last time you purchased a software solution or a service? What was that decision-making process like? Whose budget does it fall under? So if it falls under the marketing team's budget versus the sales team, they might be thinking about pricing very differently. You can ask what they think is a reasonable price to solve their pain points and how much is too much for them. So you get an idea of a range of where you can be thinking about. Number 2 is to keep your pricing structure simple. So keep it in line with how customers are used to buying and make it easy to budget from month to month. So pricing is not the place to innovate here. If your customers are used to paying in a particular way, monthly subscription, per transaction, per user, don't stray too far from that. Anything vastly different will just be another thing they have to wrap their minds around and then have to get buy-in for. And also, don't create pricing that varies wildly from month to month. If it varies too much, it's going to be hard to budget for. It's going to be hard to get approved, especially in larger companies. Tip number 3, don't price too low. So a lot of startups end up pricing too low because they lack proof points and therefore they lack the confidence to value the product for what it's really worth. They'd rather price their product low to quickly land the deal than really spend the time to let the market tell them where they should be. And remember, it's easier to decrease prices than increase prices. So keep that in mind when you set your initial price. Tip number 4, build confidence and buy-in during your sales conversations. So if you're truly solving a pain point and you have a great product, you should make your customers understand and fall in love with your product before you get into the pricing conversation. If a customer wants to talk pricing earlier on in the conversation, they're likely price shopping, and you don't really want to play that game. If they really make you, they corner you into talking pricing earlier on in the conversation, give a range. Basic customers pay this, bigger established customers pay this for a more premium product. And then once you get to that point, communicate your pricing strategy in real time. So either in Zoom or over the phone. If you send it over email, you'll miss the chance to get feedback. So give them the price, let them process it, and then ask them for their initial feedback. I think you'll get really valuable information on how to close this particular deal, or at the very least, get some information on how to approach the next deal. And then last step, keep revisiting your pricing strategy. So just because you've gotten some market validation from a few customers doesn't mean it should be set in stone. Markets and trends change, customer needs and budgets change. So stay close to your customer and constantly reevaluate. Pricing is really an art and not a science, because you're dealing with people, your potential customers who are making decisions on how to solve the problems. So it's really best to get to know them, their pain points, and understand kind of the psychology behind how they're making their purchasing decisions. So that's it. That's all I have. Hope that's helpful.
Yeah, it's super helpful advice. And I think there's an overarching thread in this. When I see a founder come in and say, hey, we've created a new product that has improved the experience and quality of service in a space, and it's got all these bells and whistles, and we're going to be cheaper than everybody else, I wonder why I'm bothering to hear the last and.
Exactly.
I don't think winning on price is usually the right game to be in, because it's typically a race to the bottom. The game is to win on creating value. And so pricing should be an afterthought. It's like, yeah, you're going to stay at the market price. You don't be more expensive or less expensive, but you're going to do something better. Now, there are some scenarios where you're fundamentally changing a cost structure of an industry, where you've taken something that was labor that cost $100,000 a year to do, and you've made it $5,000 because you've done it through technology. That's a different conversation.
Right.
But when it's kind of more head to head and you're upgrading some existing behavior or service, pricing isn't really the best way to try to compete. It should be around everything else. And so that is a different mindset. And by the way, I started a company way back that was essentially a negative price on search engines, right? The idea was you'd use our search engine. We had a feed coming in from one of the other major search engines at the time, and you would earn money that you could keep or donate to a charity. It was essentially a negative price. And that's where I came out and realized pricing isn't really what motivates people to make buy decisions. It's the thing they consider after they've already narrowed down the list of which vendors are viable, which solutions are viable, which things make sense for their life. So pricing is an afterthought at some level. And, entrepreneurs really, you got to get the pricing right. You have to be thoughtful about it. Fong's advice is dead on. But, just know it's not the first. You shouldn't be going to market saying we're going to win because we have a lower price, full stop. There's got to be a lot more to it.
Yeah, if you have a truly differentiated product that provides a lot more value than everything else, then you really shouldn't have direct competitors that you should be comparing in such a detailed way you're pricing against.
Yeah. Thank you, Fong. Awesome as always. If you're looking for more business insights, I'm down at a conference in Miami. Just met Uri Levine, who's the founder of Waze and another unicorn. He's got a book out. Very nice guy. He's got a book out to help entrepreneurs think about how to build businesses. It's Fall in Love with the Problem, I believe is the title of it. Really centered around understanding problems more than solutions, and the solutions kind of deliver themselves. Sounds like it's an insightful piece of content. We're going to link to it in the show notes, and hopefully it's helpful to y'all.
Mark, I like your Florida appropriate shirt.
I actually thought if I'm going to be in Miami, I should be wearing lime. Doesn't that make sense?
No, it's very Southern Florida.
I'm on brand. It's actually my only lime shirt, but it's polo anyway. Yeah.
The more questionable thing is whoever designed the hotel you're staying at.
But yeah, this is the W in Miami, and Yeah, a bit dated. Bit dated.
Yeah. I think W had their moment, and I think I think they got bought by Marriott or one of the big hotel chains, and they just weren't able to keep innovating. And you had so many other new hotels come in that it's just become kind of blah now.
Yeah, it's not. It wasn't a wow experience, but whatever. Yeah, I'm a simple man. Hit the bed, shower, out to do meetings.
No bed bugs.
No bed bugs so far.
You check.
Well, no, I think you see
my
bites on
girlfriend
your
when
legs.
we walk into a hotel room. Well, I'm not kidding. This is a true story. We walk into a hotel room and she goes, "Don't move." And she goes over to the bed, and then she goes, "Huh!" and pulls the sheets away to try to see if she can catch them before they run away.
But were there any bugs?
No, never yet. I don't actually think you can catch bed bugs that way, to be honest with you.
Well, so this is just paranoia. This isn't like a real
pure paranoia, and you know what? It makes her feel
I don't know
better,
why people are so afraid of bed bugs. What the fuck? You trash the bed. You get a new bed. You spray some stuff.
They get in your clothes and the carpet. You have to fumigate the house. Roscoe's got to come in. The bed
It's such a thing. I know a guy who's like the bed bug clean guy. He that's his company. He cleans the bed bug situations.
Dude,
when I met him, he was uncomfortable telling me what he did because I think so many people get worried that he's going to like transmit bed bugs to them, like he's infected. And we had this whole interesting conversation about like there's a social stigma in his job that makes his life a little bit weird. It's probably like being an executioner 200 years ago. Like no one liked that guy. Well, there's the bed bug guy. And I didn't even think anything of it because I'm not paranoid about bed bugs, but whoever your friend is, probably a problem.
I'll tell you a great bed bug story next time I see you.
Okay. All right. Well, I'm glad everyone was probably really excited to hear that banter. We're back at it. Mike, let's get the update. What are we doing?
I think it'll be fun to talk about how the new Series A is the old Series A again. Just a little different.
Isn't that just mean it's a Series A?
Well, they're calling it a seed extension, man. So it's different. It's not the Series A, optics are everything. It's fun to see. I mean, I think, in the peak of the mania, call it a year to 2 years ago, then, you had founders raising seed extensions, but it was more opportunistic and, maybe they had a little bit of revenue and they could just get some more cash and the prices were high and whatever. And then you see these monster Series A's, 20 and 100, 120, 130, et cetera. And those rounds were just absolute bananas, right? Those were, maybe $1 million ARR businesses raising $100 million valuations. So now what we're seeing, which is interesting, is that those companies are raising $5 million rounds at $2 or $3 million of ARR. And, it's anywhere from $25 to $50 million valuations. And it's funny, they're calling them seed extensions. And if you look at the news, you'll see like, oh, Series A rounds are not down that much in valuation, maybe only 10, 15, 20%. But in reality, they're just calling it a seed extension and they're just raising the round that way. So it's been a fun trend to see. I think there's a lot of psychology around it, but at the end of the day, I think it's great for founders and great for investors.
Someone told me once that when the government doesn't like the inflation numbers, the consumer price index, which is what they use to measure part of the inflation, they'll actually choose different brands of milk so that they can say, oh, inflation didn't go up.
Yeah.
And they're looking at a brand of milk that maybe was cheaper before or whatever. This is the same kind of thing. This is a little bit of funny math.
Yeah.
I feel like the numbers we're seeing, we talked about this before, reported by PitchBook and all the organizations that are kind of aggregating the data. It's not they're not wrong, but what's being reported, we think, is very carefully understating the change in valuations that were actually happening on the front lines of the market.
Yeah, it's at the point now where I don't tell people that we're a Series A firm. I say that we invest in rounds between $4 million and $15 million in size. Because it doesn't make any sense to tell people you're a Series A firm. It doesn't mean anything anymore. It's like, cool, what's the valuation we typically enter a business at? That's the way I think we need to think about it now.
This is so my experience, I don't know, like when I started in this business in 2006, seed wasn't a thing. Seed was synonymous with friends and family.
Yeah.
I'm doing my seed round. That meant you were like doctors, lawyers, it was non-institutional capital. All that changed and it shifted things around. There's always these moving targets around the definitions. I have a feeling, though, this is going to just start to shake out in 6-12 months from now, look a lot like it just did in 18-19, where it was kind of, we knew what they meant. We knew what the labels meant.
It's happening. I'm perhaps not as optimistic as you are that the labels will return to normalcy. I think it's like the consumer price index. Once people learn that they can manipulate what they call something, they're never going to stop manipulating it, right? So I think, like, I'm not going to sit there to founder and say, hey, founder, no, this is your Series A. If they want to call it their seed extension, I don't care what they call the round, as long as it's a good company at an entry price that's reasonable for us and our LPs. So I think it's sort of like a fun dance that's happening in the market. And yeah, maybe it'll shake to a certain point, but at the end of the day, it's like, where are you investing?
Right.
So,
all right, state of the market, more weird chaos as things get reset back to normal.
Do you want to talk about the Thrive Capital Management co-sale?
Only if you want to, man.
Cool. Well, just to recap, it was announced this week that a group of 5 investors led by Bob Iger and Henry Kravis of KKR are buying a minority stake in the firm Thrive Capital for about $175 million. Should get them about 3.3% of the firm. I think the trend here is that it's the same trend that's been happening for the last really 5 to 8 years. It's the institutionalization of venture capital. There's a lot of private equity funds out there that are publicly traded. You can buy stock in KKR. There's a lot of private equity funds that have had big sales where other firms either buy some of the management company or they go public. But you haven't seen that in venture capital yet. And what this really is, and with with Sequoia flipping over to an RIA and now Thrive selling a portion of the GP in the management company, is that you're seeing the institutionalization of venture capital. And we knew this was happening already, but this is kind of like the transactional viewing of it as well. This is what it's worth.
It's really interesting. And, I think got to know Josh a little bit over the years. I think quite highly of him. I think he's a bit of a trendsetter. So my suspicion is when he makes a move like that, because he's kind of ahead of a lot of the pack, there will be other firms that look at this and follow.
Totally.
For sure. And the institutionalization broadly, I mean, I was having the same conversation last night with an entrepreneur, that the whole top to bottom ecosystem now is a conveyor belt machine, right? There are certain expectations around stages, operating performance. All the capital, almost all the capital now is institutional. This was kind of like a club effort 20 years ago.
Yeah.
And even before that, where, your parents threw in some money, you tried something, maybe it worked, if it stuck, maybe you could find one of those VCs. And then if you got with the VCs, then there was a machine, a conveyor belt for part of the journey. Now it's increasingly end-to-end, institutionalized, professionalized, which I think overall is wonderful for, innovation and output.
Totally agree. So anyway, congrats to the Thrive team. It's awesome.
Yeah. All right. Cool. Thanks, Mike.
Later, dude.
Chris, we're back at it for the year. What do you got for us?
Let's start with what we always do, which is inflation and the Fed. We have, the headline is this, Mark. We've come a long way from the peak of the inflation that we experienced last year. Hot off the press this morning, we have the PCE inflation data. And again, this is the Fed's preferred measure of inflation. The print came out very interesting, positive 0.2% month on month for December, which is the slowest since January 2022, and significantly off the cycle high at 0.7% in October. And core inflation, et cetera, showed the same trend. The best part of this report for me is related to what we talked about internally last week, that real disposable income, that's inflation adjusted household disposable income, increased by 2.5%, which is slower than the month before and slower than the month before that. And real consumer spending is actually decreasing at a faster than expected speed. So in December, it decreased by 3.4%. And that's on the back of a negative 2.4 print in November. So as a result of all that, personal saving rate, that's a percentage of saving, household saving as a percentage of the disposable income, has finally started to sort of reverse the mean. we talked about this, but over the past 10 years, U.S. household saving has consistently, forget about the pandemic period. That kind of just messed up the whole data series. But before the pandemic, households stayed consistently above 6% in household saving. After January last year, we dropped all the way to 3%, and we hit a low in September of 2.4%. Okay, and now finally that trend is reversing. This to me is probably the best part of this of what we've seen in the past 6 months. The households finally starting to conserve capital, trying to spend less and save more, and potentially plan for a downturn that's ahead of us. And the only blemish of this report I have to mention is that inflation, as we talked about, has goods and services. Goods has been the one that sort of helped inflation coming down in the past couple of months. Services, unfortunately, is still a little bit sticky, still showing positive trend, and that's the part that we really have to watch for inflation going forward if we want to come back to 2%, which is the Fed's target. And all this is to say that we're heading into another Fed meeting in about a week, less than a week, and market has completely priced in a 25 basis point increase, the slowest since the Fed started hike, really this hiking cycle. And I do think that's likely what's going to happen, and the Fed will slow down accordingly after that. So
headline
we're
is the Fed's program of raising interest rates has had its effect, right?
Yeah.
It's brought the economy back into a new equilibrium. Do you think inflation is still going to be it's been the topic for us, Chris, for months and months and months now. Is it going to fade to the back, or are we going to still be talking about this every day?
That's a good question. So up until now, right, every market participant's main focus has been inflation, has been the Fed. And more importantly, the volatility that we've seen in the public markets and sometimes in the private markets has been largely driven by the volatility or uncertainties, right, in the prediction of what's ahead in terms of macroeconomic decisions, interest rates, inflation, jobs, you name it. Now that we've come a long way, inflation is showing the right trend, and sort of actual data are starting to match predictions, expectations, and also what's priced into the market. Going forward, of course, barring any major surprises from the inflation trend or the Fed sort of guidelines on their interest rate hikes, which I think are very unlikely at this point, I personally think that the volatility of the market will be more driven by the secondary effect of all these macroeconomic data, which is corporate earnings. And speaking of corporate earnings, we're in the middle of it right now for Q4 last year, Q4 earnings. Based on what we've seen, it's sort of what we talked about before, which is, we're entering a sort of the second phase of correction, that corporate earnings are starting to adjust. More importantly, the guidance for 2023 and 2024 beyond are starting to adjust downwards. Financial sector, we've seen Goldman, Morgan Stanley, American Express, pretty horrible earnings and even worse guidelines going forward. The tech sector will also be hit. Microsoft, really poor guidance, even though they beat earnings, but very poor guidance for 2023. But on the flip side of that, airlines and energy sectors will likely do pretty well, just given, that's where sort of consumers are still spending a lot of money, and energy prices, given the supply demand picture on a global stage, is still very imbalanced. So, to answer your question, coming back to your question, right? Earnings is going to be very important. Earnings is going to be what everyone looks at going forward, and the uncertainties between prediction and actual is going to be what's driving the volatility in the market.
Okay, but you're not mentioning in all of this, you haven't brought up jobs and the unemployment rate. It seems like that's getting kind of a holistic recap on the market, a missing piece of this. Where are we with that?
So this is where things gets a little bit interesting, and it becomes, you have to really, on the one hand, be patient with the data, but on the other hand, try to delve in and look at the underlying tone of the data. So the latest is that the non-farm payroll data, which is the number one job data in the US for December, has again come out very, very strong. We're at plus 223,000 jobs in December. And that brought down unemployment rate to, again, a historical low of 3.5%. So from the look at that, that gives the Fed sort of bullets to march ahead in terms of hiking rates, and which is negative for risky assets. But if you look at the second part of the report, which is average hourly earnings, that has finally come down, right? So it's still positive, but the growth rate has come down. And what's more encouraging is labor participation has also come up, right? So you can't look at the job data without looking at the unemployment rate and the job data in conjunction with the labor participation rate. If labor participation goes up, likely that will translate to some sort of unemployment, higher unemployment, and potentially lower wages. So we're seeing labor participation going up now, finally, which means probably households are exhausting some of their savings from the pandemic era, and they're now looking for a job, which will hopefully eventually in a couple of months translates to a lower unemployment, a higher unemployment rate, and a lower hourly earning rate, which will then translate to likely lower inflation. But all that is actually still constructive for demand, which will then translate into corporate earning. So this is a healthy path, is what I'm trying to say, and more attention will be given to it going forward for sure.
Okay. Anything else people should be thinking about or worried about right now?
For 2023 in particular, we're going to see my thought is that we're going to see a reversal of a lot of the trends that we saw in 2022. And one of them, probably the most important one for me, that I think everyone should really watch out for is US dollar, the strength of US dollar. The Fed was ahead of the curve in terms of hiking rates versus the rest of the developed market in 2022. Therefore, US dollar saw a significant increase in strength. That translated into corporate earnings, energy, has ramifications across the globe. This year, again, the Fed is, at least the market thinks that the Fed is going to be ahead of the curve in terms of tapering the hike, right? So in terms of this sort of just either staying on course or potentially even cutting interest rates toward the end of the year. And that has translated into the weakening of the US dollar in the past couple of months. We've seen, in fact, around a 12% decrease in US dollar value versus the major peers since October. So really in the past 2 to 3 months. This will then translate into many different things. So at the top of my head, what's relevant really for us, and think about the international M&A market. So international firms that are based, let's say, in energy-intensive countries that are already benefiting from the current energy dynamic and increases in price in prices of energy, which will translate into a large amount of corporate earnings, now are getting another boost from the weakening of the US dollar, which they do not have as their major currency reserve. How would they spend the money? One logical conclusion, especially taking advantage of the weakening of sort of the US M&A market and IPO market, could potentially be that these firms that are based, let's say, in the Middle East or China, come to the US and start sort of really driving the M&A market, M&A activities in the US, which could translate into nice exits for US firms, and that could lift up the venture and private equity space. So that could be huge for us. And also for US companies that have large international presence, we're thinking, McDonald's, Procter & Gamble, consumers, and of course airlines. As the dollar weakens, the demand of these products and services of these companies internationally will increase, and that will then help hopefully translate into the earnings of these companies. So many ramifications that I think everyone should go through and really figure out and analyze how that specifically impacts, how the weakening of US dollar specifically impacts their particular sector.
Fascinating to think about. I mean, it's kind of standard to think about the change in the value of the dollar, and it changes the equilibrium of what's being sold abroad versus domestically.
Yeah.
Got it. The idea that it's going to be an opportunity for a buying spree for cash-rich countries and American companies. That's fascinating, and probably does have a lot 100%. Of really practical implications for entrepreneurs who are looking for liquidity right now. Okay, thank you, Chris. Appreciate your time.
Of course. Pleasure.
A reminder for everybody, Chris is an SEC-registered RIA, and nothing he said should be taken as financial advice. Thanks, everyone, for listening, and welcome back to the pod. If you're traveling to Miami this year, hot tip, bring a sweater. If you've got any other awesome travel tips, I always want to hear them. Let me know, and you can hit me on Twitter @MPD. Take care.